All right, welcome. In this explainer, we're going to map out your entire journey into the world of mutual fund investing. We're going to cover the why, the what, and the how, so you can really move forward with some serious confidence.
Put simply, a mutual fund is kind of like a giant potluck for investing. You and thousands of other people all chip in your money. Then a professional fund manager takes that big pool of cash and invests it in a whole bunch of different things. Stocks, bonds, you name it. It gives you instant variety and expert management, all without needing to be a millionaire or a Wall Street genius.
Now, mutual funds basically come in three main flavors. You've got your equity funds. They're all about stocks, aiming for big long-term growth, but yeah, they come with more risk. Then there are debt funds, the more cautious choice, investing in safer things like government bonds for stability. And of course, you've got hybrid funds, which, you guessed it, mix them both together to try and give you a balanced ride. Which one's for you? It all comes down to your goals and your stomach for risk.
So, if we're going to use this map, we need a toolkit, right? When you start looking at mutual funds, you're going to see all these terms thrown at you. Let's cut through the noise and break down the absolute essentials you've got to know to make a smart decision.
First up, NAV. That's net asset value. Don't let the name fool you, it's super simple. Just think of it like the share price for a stock. It's the price for one unit of the fund, and it's updated every single day. Watching the NAV is how you track how your fund is doing. Okay, listen up because this one is so important. The expense ratio. It's the yearly fee the fund charges you to manage your money. Now, it might look like a tiny little percentage, but trust me, over 10, 20, 30 years, a high expense ratio is like a slow leak in your investment bucket. Just remember this, a lower expense ratio is almost always better for you. All right, and exit load. Think of this as, well, it's a fee you might pay if you pull your money out too soon, usually within a year. Fund companies put this in place to encourage you to think long-term and not panic sell when the market gets a little shaky. So always check the exit load period to make sure it matches up with your plans. Now let's get into a pro-level tool, Alpha. This is basically the fund manager's report card. It tells you how much better or worse the fund did compared to the overall market. So positive alpha means your fund manager is earning their keep. They're actually beating the average. It's a fantastic way to spot real skill. So, we have our map, we have our toolkit, but where are we actually going? The best tools in the world won't help if you're headed in the wrong direction. That's where your compass comes in, and your compass is your own personal financial goals. Think about the big stuff in life: buying a house, making sure your kids can go to a great college, building a retirement where you can actually relax and enjoy yourself. These aren't sprints, they're marathons. And for those long-term goals, you need an investment that can really grow over time. Something that crushes inflation and builds real wealth. Check this out. It's a perfect example of how your goal changes everything. Let's say your goal is saving tax. On one hand, you've got the super safe PPF, but look at that lock-in, 15 years. On the other hand, you've got an ELSS mutual fund. It's tied to the market, but the lock-in is just 3 years. It gives you the shot at real wealth creation and the tax break. So you really have to ask yourself, who am I as an investor? If you're 25 and just starting out, you've got time on your side. You can handle the roller coaster of the stock market. But if you're 40 with a family, you're probably zeroing in on specific goals, like college funds. And if you're 55, your game plan is totally different. It's all about protecting what you've built. Your stage in life is your ultimate guide.
Okay, let's bring it all together. We've got our map, the world of mutual funds. We've got our toolkit of key terms. And our compass, our personal goals, is pointing true north. With all that, we're ready to look at the path ahead and the simple habits that can build a lifetime of wealth.
You know, this is really the whole game right here. It's about changing your mindset. It's about turning your money from a lazy roommate sitting on the couch into an employee that works for you 24/7. That's what smart investing is all about, making your money work just as hard as you do.
And here's the magic sauce that makes it all work: compounding. Just look at this number. The Indian stock market has delivered an average return of almost 16% a year since 1979. At that rate, your money would have doubled on average every 4.5 years. That's not just growth, that's explosive wealth-building power. So, how do you get this incredible power working for you? It's surprisingly simple. It comes down to 2 habits. That's it. First, start a SIP, a systematic investment plan. Just invest a fixed amount automatically every month. It builds incredible discipline. And second, stay disciplined. The market is going to have its ups and downs, but the key is that the longer you stay in, the lower your chance of losing money becomes. It's not about timing the market, it's about time in the market. And this right here, this shows you why now is such an exciting time.
The Indian mutual fund industry is absolutely booming. It's grown 5 times over in just 10 years. But out of more than 1 billion people, only a tiny fraction are on board. You're getting the knowledge right now to be part of this incredible growth story.
So there it is. We've shown you the problem, we've handed you the map, the toolkit, and the compass. The entire journey is laid out right in front of you. The only question left to answer is yours. When will you take that first step?